Hello students, welcome back to the discussion on CSEET, Economic and Business Environment paper. Now here we would be starting our discussion on chapter number 3, which is titled as the Indian Union Budget. Now this is one of the most important topics every economic student should know, and it plays a very important role in the business environment of any country. Now the Union budget is also called the financial policy of the central government. This is where the finance minister of the country would discuss about the various projects which the government wants to take up, and also the funds the government is ready to reserve for the particular activity. This also gives the direction in which the country's economy would grow, and it makes the intention of the government very clear. So that is why every year during the month of February, it is a very common factor for all those who are interested in the economic activities and the functioning of the economy to watch and to follow the budget news. Most of the things that is presented in the budget might not have a direct impact on our lives, but everything that is presented in the budget will indirectly have an impact or influence on our day-to-day life as well as on our economic activities. So understanding the budget in depth and gaining the capacity to analyze it becomes very necessary. That's the reason why this chapter has been included in the CSEET syllabus for the aspirants. So let us take this chapter bit by bit and try to understand the entire process of union budget. Let's begin with some of the interesting facts. So the first interesting fact is the first Indian budget was presented by Mr. James Williamson on February the 18th, 1869. So this is almost 151 years ago, after Indian budget was introduced on April the 7th, 1860 by East India Company. So for the first time, the entire country-wise budget was presented by East India Company in the year 1869. The first budget of independent India was presented by the then finance minister, Mr. R.K. Shanmugam Shetty, on November the 26th, 1947. So independent modern India's budget was presented by R.K. Shanmugam Shetty on November the 26th, 1947. Till 1955, that is 8 years after independence, budget was only printed in English language. However, from 1955-66, budget started getting printed in both languages, that is Hindi as well as English. So these are some of the important things that are given to us in the reference material. Some more interesting facts are listed out for us. In the British era, the budget used to be presented at 5 p.m. because when it is 5 here, it is around 11 p.m. in the UK. This practice was discontinued in the year 2001. Yashwant Sinha was the finance minister then under the prime ministership of Atal Bihari Vajpayee. So after 2001, budget is being presented at 11 a.m. Until 2017, the ritual to present the budget on the last working day of February. From last 2 years, budget is now presented on the first working day of February. Very important. Because in India, we have two calendars. One is the calendar year and other is the financial year. In most of the countries, there is only 1 year. That is the calendar year itself is a financial year. So slowly, we are taking the budget back, and in the years to come, in India also, the calendar year as well as the financial year will become the same. Mr. K.C. Niyogi and Mr. H.N. Bahuguna were the only two finance ministers who did not present the Indian budget. Maybe by then the government would have fallen or the finance ministers would have changed, and that's the reason these two finance ministers, they have not presented the budget. Some more interesting facts. The record of presenting maximum number of budgets is held by Sri Morarji Desai for presenting 10 budgets. He was also the prime minister for a brief period soon after emergency. He was the leader of the Janata Party. So he was the finance minister during Nehru's time as well, and he has presented 10 budgets. For the first time in 92 years, Indian Union budget of 2017 merged with the Union budget of Rail budget, which was usually presented separately. This is also important. Railways is such a big company in India that the budget was presented separately. That is one day before the union budget was presented. But from 2017 onwards, the railway budget has been merged with the Indian Union budget. So these are some of the interesting facts that are listed out to us in the reference material. Anyway, we will take up the other important things that we have to learn from this chapter in the next part. In this part of the video, we would be discussing the key terminologies or the important heads that are covered under the union budget. See, we all know in the month of February, the finance minister of the country would be presenting the union budget. Now, when we read, we need to understand certain things. To understand the union budget, there are certain important key terms which we should be aware of. So in the next few minutes, we would try to discuss and understand the different heads and different words which we should know. If we know that, it becomes really important, or it becomes really easy for us to understand the budget. Let us start. What is annual financial statement? Now, what does it mean? According to Article 112 of the Indian Constitution, this article number is very important. According to Article 112 of the Constitution, the government requires to present to the Parliament. Parliament is the assembly of all the elected members, a statement of estimated receipts and expenditure. So what is the money that is coming into the government and what is the money that is going out of the government? So that statement should be presented to the Parliament every financial year, and the financial year is from April 1st to March 31st. This statement is the annual financial statement. So it's very simple. What is annual financial statement? According to Article 112 of Indian Constitution, government should present to the Parliament the statement of the financial year. So when does the financial year start? On April the 1st. When does it end? On March the 31st. What is the money that has come? That is called the receipt, and the money that the government has spent, that is expenditure, to the Parliament. So this statement is called the annual financial statement. So two important things to remember here. One is which article, according to which article the financial statement should be presented. It is Article 112. And when is the financial year? Financial year is between April 1st and March 31st. Right, so let's continue our discussion on annual financial statement. How long is the annual financial statement? What is the length? It is around 10 pages long. So in 10 pages, the finance minister would cover all the receipt and expenditures that the government has done. Name the parts of the annual financial statement. There are three important parts in the annual financial statement, which is very important. First one is the consolidated fund. Second is the contingency fund. And the last one is the public account. So these are the three important heads that one would find in the financial statement. So first question, how long is it? 10 pages. And which are the important parts? Consolidated fund, contingency fund, and the public account. Right, consolidated fund. So what is consolidated fund all about? All revenues raised by the government, money borrowed, all the revenues the government is getting, all the money the government has borrowed, receipts from loans, if government has given loan, if the loan has been repaid, given by the government, flow into the consolidated fund. It means that all the money government earns should come to the consolidated fund. Very simple. So all that government earns should be deposited into one account, and that account is the consolidated fund. All government expenditure is made from this fund. So when government has to spend, it should go from the same account. So what do we see here? Say this is the consolidated fund account. So all the money government earns will come to consolidated fund, and all the expenditure government has to make will go from the same account. So this is revenue and this is the expenditure. So this is a very, very important account, and the name of this account is consolidated fund. Contingency fund. The word itself tells contingency. So it is a plan B, right? If something goes wrong, so we are ready with something else. From where does the government meet the exceptional expenses? It means that something happens all of a sudden which none of us would have even thought about it. That kind of an event happens. So to meet that, money is required. So where do we bring such money? We bring such money from the contingency fund. Exceptional items are met from the contingency fund or even the public account. So during the time of exceptional expenses, we take money either from contingency fund or from the public account. No money can be withdrawn from the fund without Parliament's approval. But to meet such exceptional expenses, we can take the money either from the contingency fund or from the public account, but Parliament's approval is required for it. What is demand for grants? Government, according to Article 113, again article is to be remembered by you, according to the Constitution, Article 113, the government should present an estimate of the expenditure in Lok Sabha and it should be voted. So all that the government want to spend in a particular financial year should be presented to the Lok Sabha according to Article 113 and it should be voted. It means that all the members of the Parliament should vote for it and it should definitely get more than 50% of the votes. Then what happens? What are the things the government would be presenting in the demand draft? Revenue expenditure, capital expenditure, grants to states and union territory government together with loans and advances. We will be discussing in length what is revenue expenditure and what is capital expenditure. In simple terms, the money that the government is planning to spend should be told to the Lok Sabha and Lok Sabha should agree to it. And the grants that the central government wants to give to the union territories and states may be in the form of loans. Even that should be informed to the Lok Sabha so that Lok Sabha understands it, votes for it, and then government can remove that money from the consolidated consolidated fund and spend it. So such a statement which the government presents is called demand for grants. So government is demanding that it should be given money so that it can meet all its expenditures. So that is demand for grants. What is appropriation bill? Appropriation bill gives power to the government to withdraw funds from the Consolidated Fund of India for meeting the expenditure during the financial year. So consolidated fund is here. Government presents the demand for grants and Lok Sabha votes for it and gives the consent to withdraw the money. And after that, according to the appropriation bill, the government can withdraw the money from the consolidated fund. Appropriation bill is introduced by the government post the budget discussion in Lok Sabha. So what happens now? The budget is presented. All the expenses that government is expecting to incur in the financial year is told to the Lok Sabha. Then the government will present the demand for grants and then there will be discussion on the budget. Finally, the government will pass the appropriation bill, as a result of which the government will get the power to withdraw the money from the consolidated funds. Very, very important. What is finance bill? According to Article 110, first we saw Article 112, then we saw Article 113, now we are seeing Article 110. According to Article 10 on finance bill contains the proposal of the government for levy of new taxes, modification in the existing tax rate. Please understand this. Levy of new taxes, modification of existing tax structures, or continuance of the existing tax structure beyond a period approved by Parliament are submitted to the Parliament through this bill. So finance bill, very simple thing to be understood, deals with taxation. If government wants to introduce any new tax, it has to present it to the Parliament. When they present it, it becomes the finance bill. If they want to continue a particular tax at the same rate for an extended period, say for example, a tax is introduced for 5 years, example, at 2%. Government wants to extend it for another 5 years at same rate of taxation. Then the government should tell that we are continuing it at the same rate or at the changed rates. All such things are presented. The information presented to the Lok Sabha based on tax is called the finance bill. finance bill can be introduced only in Lok Sabha. There is no need to present it in Rajya Sabha. The bill has to be passed in the parliament within 75 days. So within 75 days of introduction of the new finance bill or the new taxation, it has to be passed. Then there is a thing which says that the Rajya Sabha can definitely give their opinion or suggestion for the improvement of the finance bill, because finance bill deals with tax. Very important. Make sure that you read this 2-3 times and you understand it perfectly. What is contingency fund? An urgent or unforeseen expenditure is met from this fund. This all of us do it. We keep aside some money and tell that we are not going to touch it unless it is an emergency. So it is a reserve fund that we keep for the times of emergency. So that is called the contingency fund. Contingency fund in India is 500 crore rupees. Important. This number can be a question. What is the amount that Indian government has set aside, telling that we will not touch it under any circumstances unless it is very, very serious? So the amount that the Indian government has kept aside is 500 crore rupees. This fund is at the disposal of the president of the country. So who handles this fund? It is handled by the president of the country. The utilization of this fund needs approval from the parliament. So the parliament will gather, they will discuss, then decide whether that emergency fund or the contingency fund should be removed or not. The fund used from the contingency fund is to be returned. So government borrows this 500 crore rupees, for example, they meet some unforeseen expenses. Once things settle down, once the economy is back in normal, that money has to be returned to the contingency fund. At any point of time, the balance should be 500 crore rupees. So that is about the contingency fund. Easy to remember, easy topic. What is public account? It is the fund to account for flows of those transactions where government is merely acting as a banker. Say for example EPF. EPF stands for Employee Provident Fund. So this is the fund that is available. All the employees and the employers will pay money to this fund. Fantastic. So later what happens? This fund will be used by the government, of course, and when the employees ask for this fund, the money has to be returned by the government along with the interest. So what happens now? It doesn't belong to the government. The money that government collects in the form of tax is government's money. But the money that it is in the public account is not government's money. Government is just playing the role of the banker. Whenever the people of the country ask for it, the government has to return that amount. So such an account is called public account. Expenditure from public account are not required to be approved by parliament. So government can take the money, spend it, but when the public asks for it, they have to return it along with interest. But government has to present the receipt and expenditure statement. So to the parliament, government should tell what is the money that they have received and what is the money that they have spent and how are they going to repay it. So such details should be given to the Lok Sabha. So this is about the public account. So these are some of the important terminologies which all of us should know before taking a detailed study on the budget.